Well, good morning, everybody. And once again, my name is Stephanie Gadwa, and I am pleased to be your event chair for this morning's breakfast. Before we get our programming underway, it's important that we acknowledge that we are on the traditional territory and home of Indigenous people, the Wendat, the Anishinaabe, the Haudenosaunee, the Chippewas, and the Mississaugas of the Credit First Nation, steeped in a very rich history dating back many generations. The purpose of our acknowledgement this morning is to show our gratitude and respect for their contributions as we recognize the role of treaty making in what is now Toronto. For those of you who aren't familiar, the Economic Club stands as Canada's national podium of record. We are the only nonpartisan national public policy platform that unites leaders, experts, and innovators from across various sectors to discuss and address key issues facing the future of our country. Our foundation is firmly Canadian, yet our influence spans well beyond our borders. Our commitment to fostering collaboration, promoting thoughtful debate, and encouraging action continues to drive the work that we do. The Economic Club is more than just an event podium. It's a platform for transformative ideas, helping guide Canada towards a brighter and a more prosperous future. So I would now like to introduce Peter Routledge. Peter is the Superintendent of Financial Institutions. He's going to deliver a short keynote followed by a fireside chat alongside Robert Essling. Please help me welcome Peter.
Good morning, everyone. It's great to be here. Great to see so many familiar faces. If the coffee and the good company hasn't woken you up, here comes the bank regulator to really bring it home and get the day off to a good start. So thank you, Stephanie, for the very kind introduction. As you pointed out, the Economic Club of Canada provides a highly respected, nonpartisan platform for leaders in the private and public sectors to provide their views and answer direct, topical question. So with that in mind, I'll make a few opening remarks and then do my best to answer my old friend and colleague Robert Esselin's and your questions. So I have the privilege of serving as Superintendent of Financial Institutions. I lead an office of dedicated public servants to whom Parliament has assigned a specific and narrow mandate to ensure Canada's financial institutions are resilient in the face of uncertainty and volatility. Parliament further narrows our focus to protecting the rights and interests of depositors, insurance policyholders, and creditors, having due regard to the need to allow financial institutions to compete effectively and take reasonable risks. We do this via two central activities at OSFI. First, we write and promulgate principles for reasonable risk-taking in a competitive marketplace via regulatory guidelines. Crucial difference in our system versus others, we don't make rules. We articulate principles and we articulate them through something we call regulatory guidelines. Second, we supervise financial institutions to measure their adherence to those principles. If we carry out these activities effectively, the Canadian financial institutions that we oversee will be resilient to the trials produced by uncertainty and volatility. We take our responsibility very seriously, given the importance of the financial sector to Canada's economic fortunes. The institutions we supervise carry approximately $12.2 trillion in assets on their balance sheets. Not an insignificant figure, given that Canada's economy is roughly $3.2 trillion in size. I've spoken recently about the resilience of Canadian financial institutions have built over the past several years. For example, Canada's systemically important banks reported capital ratios we call Common Equity Tier 1 ratios of 13.7% on average. And that is 220 basis points above the floor for a well-capitalized, systemically important bank. Elsewhere, Canadian life insurers have boosted their core capital ratios by 13% over the past 6 years, and maintain ample capital buffers that can be similarly leveraged for new investments in the Canadian economy. And yet, I think it is fair to say that the uncertainty facing Canada and its financial sector is unusually elevated. Let's talk about that, and let's start with the good news. Given the resilience in the financial system, this new era we have entered does not feel to me like the first decade of this century, the decade that housed the global financial crisis. Yeah, I worry about market valuations, which are quite elevated relative to most cycles, and I worry about innovative non-bank financial intermediaries whose business models have yet to be tested by a nasty bear market. But regulated financial institutions in Canada have stronger capacity to withstand or recover quickly from unexpected difficulties, stronger than they had during the global financial crisis. Now, that's the good news. Let's discuss the risks that do threaten financial stability. We are living through an intense period of geopolitical transformation. The post-Cold War consensus about the economic benefits produced by free trade between independent nations has frayed and will not survive in the form to which we have grown accustomed. Other risks have accompanied this transformation, and some of those risks threaten financial institutions. For example, cyber criminals regularly attack financial institutions and occasionally succeed. Transnational criminal organizations that manufacture and distribute poison conduct kinetic attacks on the physical assets of financial institutions via their money laundering activities. Simultaneously, regulated financial institutions have understandably begun to raise questions about the post-financial crisis conservatism of regulators in building more resilience into financial institutions. They argue that the shift before us demands more intelligent risk-taking to help economies shift their economic model to the world emerging, and they argue the aforementioned conservatism is an unnecessary speed bump in the way of progress. We at OSFI, as at our international peers, regularly field calls to lower capital requirements, loosen some financial standards, and lessen regulatory intensity. In other words, my regulated constituents are asking me, can OSFI listen to and act upon our sincere request to help Canada adapt to our new reality? And it may surprise you to note the correct answer to that question, in my view, is just a simple yes. Not a yes, but just a yes. In fact, we've started answering yes before these calls intensified, and in my view, before they even started. For example, in 2024, we rescinded 20 guidelines and industry advisories, and we're going to do more this November, then more again in January 2026, and then more again in May 2026. Over the next year, OSFI will deliver the most wide-ranging and comprehensive reduction of our regulatory content in our history. Earlier this year, we paused increases in the Basel III output floor to ensure that competitive balance prevails for Canadian banks that compete in the international banking system. In July 2025, we announced a reduction in capital requirements for Canadian infrastructure, debt and equity investments made by OSFI-regulated life insurers. We have sought out ideas to improve our capital requirements that will provide more opportunity to regulated lenders and investors at minimal cost to financial institution resilience. We intend to have a first round of ideas put forward later this fall. Here we have no intention of being revolutionary, just incremental and smart. We think there is an optimum level of regulation and supervision, one that lessens the likelihood that a financial shock damages the economy, but one that also avoids what we call the stability of the graveyard, in which economic growth is unnecessarily slowed by an excessive aversion to financial system risk. And that optimum level changes with the times. We are also keenly aware of the reality that we could go too far and unintentionally invite dumb risk-taking into the system. For example, Some have called for a narrowing of financial institution supervisors' aperture to just financial risks, arguing that only material financial risks pose threats to financial institutions. Now, financial risks such as capital adequacy and liquidity remain critical areas of focus for OSFI, but we have learned through hard experience that they are lagging indicators of financial instability. Experience teaches us that inadequate assessment of non-financial risks is usually the root cause of financial instability at an institution. Non-financial risks can undermine the rights of depositors, policyholders, and creditors of financial institutions. Moreover, financial risks often emerge as the final signals of that process. Therefore, non-financial risks are, in fact, material risks, and OSFI must supervise and regulate them in a manner equivalent to its supervision and regulation of financial risks. As a creditor or a lender to a financial institution, ask yourself this: can I truly find comfort in my financial institution's capital or liquidity ratios if I have concerns about its cyber risk management, its third-party risk management, the integrity of its leaders, the security of its physical and information assets, its fidelity in adhering to the laws in the jurisdictions in which it operates, the culture of the organization, and the strength of governance provided by its boards of directors? Financial history is littered by companies that failed on these dimensions, even though their financial indicators did not signal the severity of their problems, near to or until the very last day of their existence. And if you're not persuaded by this argument, please solicit the points of view of those institutions' creditors or their former shareholders. And with this penultimate point, I arrive at the final message for this speech: the fundamental importance of a financial institution's board of directors in vouchsafing both the resilience of the institution and its ability to deliver benefits to creditors and shareholders alike. If we look objectively at the performance of Canada's financial system this century, I think we can conclude that the system has outperformed many other financial systems on the dimensions of financial stability and resilience. Institutional failure has been quite rare, and our financial system has come through periods of serious to severe financial uncertainty without material disruption and with attractive profitability for shareholders. Credit for this track record does not belong to OSFI. We supervise nearly 400 institutions. Meanwhile, each one of those institutions has a board of directors focused on value creation for its shareholders. Therefore, in attributing credit for Canadian financial institutions' performance, I start with the boards of directors of Canadian financial institutions, those who oversee the management at those institutions each and every day. In fact, in the 4.5 years I have served as superintendent, I have deepened my appreciation of an enduring truth of supervision and regulation. OSFI, as the representative of creditor interests, shares common interests with boards of directors. OSFI seeks long-term resilience for the benefit of creditors and depositors and policyholders. Boards of directors seek the same long-term resilience in the service of their shareholders. Healthy profitability is good for creditors. Strong capitalization and liquidity are good for shareholders. Except in extreme circumstances, creditor and shareholder interests align, making OSFI supervisors and financial institution boards of directors natural allies. So over the past 3 years, we at OSFI have redesigned our supervisory framework to better serve our board of directors, our board of director allies. We have expanded our risk ratings considerably. Formerly, we gave just one overarching risk assessment to boards of directors. We graded a company's overall risk as either low or moderate or high. Now we provide 4 subgrades for each institution. The 4 are: 1, business risk; 2, risk governance; 3, financial resilience; and 4, operational resilience. We provide boards with an annual report card, informing them of their institution's strengths and weaknesses across those dimensions, as well as their overall risk profile, their overall grade. We also provide much more clarity on the direction of risks. This gives boards of directors clear guidance on where to focus their own scrutiny on the management of the organization, while enabling OSFI to avoid surprising our regulated constituents. Now this can feel like intensified regulatory scrutiny. We are much more critical and specific in our supervision, which in turn implies or obliges action on the part of management as guided by their boards of directors. But that action is not in response to OSFI's views, we have found. In fact, it is the boards of directors, empowered by analysis from a stakeholder that shares their interests, that galvanize management response and ultimately improvement. At OSFI, we rely on boards of directors to fulfill the important role as insightful, watchful steward over their institution's franchise value, especially when risks intensify. We know that when they do that, not only do they serve their shareholders well, they also help OSFI to protect the rights and interests of depositors, policyholders, and creditors. Moreover, board accountability and effective governance is certainly not a new expectation and remains paramount to our renewed supervisory approach. When the history of this era of OSFI is written, I think our supervisory renewal and matured attitude to the interests we share with boards of directors will go down as the difference maker in the resilience and long-term profitability of Canada's financial system. So with that, I'll thank you for your attention. And Robert, do you want to come on up and put me under the Klieg lights?
Thanks, Peter. So now I'd like to welcome Robert Asselin, CEO of the U15. He's going to moderate a short fireside with Peter.
Good morning, everyone. Bonjour tout le monde. Peter, it's great to share the stage with you.
Yeah, good to see you again.
So I was observing with Peter that we serve together in the finance department, but under very different roles and capacity. Maybe I'll start with the macro picture. Describe, maybe in more detail that you did in the remarks, how do you see the Canadian economic landscape right now?
Yeah, it's an interesting question. If you asked me that question 10 months ago, I would have given you a more dark answer. But what we have seen over the last 10 months is certainly our economic model is having to adjust to a very different international trade environment, and our darker fears that we were contemplating in February have not come to pass. In fact, we haven't come anywhere close to that. Not unusual for a regulator to be overly pessimistic and then pleasantly surprised. That's a lot better than the alternative or the opposite. The housing market, to sort of go into specific sectors, the housing market remains, depending on the city, more overall, it's weaker on a national basis. Some cities are performing quite well. Other cities are struggling. Toronto, in particular, is an area that, in the housing market, we see is in difficulty. But the market is still clearing. Creditor or borrowers are still able to renew their mortgages. The delinquency rate on mortgages remains quite low by historic standards, although well up above COVID-era lows. And the banking system continues to generate fairly healthy pre-provision earnings. So overall, the sector remains quite resilient, and the economy is adapting, perhaps not perfectly. Perhaps we'd prefer the free trade environment we had 5 years ago, but we don't have that. And the economy, as we see so far, seems to be adapting better than we thought. Doesn't mean there aren't risks ahead, but things seem to be going pretty well. Meanwhile, on the market side, which tends to affect insurers a bit more because they have long-term assets, credit spreads are at all-time lows, price-to-earnings ratios are at all-time highs. The market has a very optimistic outlook. And that gives me as much heartburn as it does hope.
So maybe given this macro environment you just described and the geopolitics that is very tricky, how do you assess the risk environment specifically to facing federally regulated financial institutions, and maybe speak to the recent shift you've seen since your last outlook?
Yeah, so every year we produce something called an annual risk outlook, and then we update it semi-annually. This year, at the start of the year, we identified residential real estate, wholesale lending, funding and liquidity risk, and integrity and security. Those are still the top 4 risks, although I think integrity and security is a little bit more in our focus, just given the opacity and intensity of risks in that sector. So that refers to things like cyber risk, third-party risk, the areas that aren't traditional areas of focus for us as regulators that we've had to sort of up our game up over the last 4 or 5 years. That's where institutions are really facing threats. The way I try to relate it to the management teams and boards of directors we work with is you're operating in this environment or a theater, and in your theater of operations there's more conflict than there's been. Sometimes cyber conflict, sometimes kinetic conflict. But you're an innocent bystander, and there's a lot of firepower out there, and your institution might get hit. And so your responsibility is to put up protections against that conflict and make sure your institution can survive through an attack. And generally speaking, we've done fairly well, but it's an area that's new, and new risks, it tends to take a few cycles to figure out how to manage them well, and we haven't gone through that full process yet. And that is an area that really keeps us up at night.
Moving to trade disputes and rising protectionism obviously complicated our economic landscape. How do you prepare to mitigate the potential systemic risk that tariffs and trade barriers could pose to our federally regulated financial institutions?
Well, what we've tried to do over the last, the answer to that question is we have the resilience we have now to fight and to contend with those threats. If we hadn't done what we did over the last 2 to 3 years, we wouldn't be in as good a position. So in effect, the answer to that question is what we did over the last 2 years is our response. And while we can still be incremental and smart, basically the best defense is good preparation. So we raised capital buffers in the banking system. We've not discreetly, but we've nudged the insurance system up in terms of capital and liquidity. We've instituted a whole bunch of non-financial risk regulatory principles and guidelines for institutions to begin to follow. Those things that we've done are what is going to provide the buffers to absorb volatility or the costs of volatility. And so I think we have a level of resilience in Canada, in the Canadian financial system, that's as high as it's ever been, and we can't rest on that. The threats are that serious, and we have to be constantly asking, do we have enough protection for those threats that we don't control? Now, on the other side of the ledger, and I mentioned it in the speech, right, reasonable people could say you've gone too far in certain areas. You need to begin to think about pulling back. The argument that particularly resonates with me is like, you've built this risk system for the risks that have occurred over the last 30 years, which is a true statement. Is the last 30 years a good predictor of the next 30 years? No. And so what do we have to do today in preparation for the next 30 years? And I think that requires a lot of engagement with industry. And we at OSFI have to approach it with an open mind, and I'll return to that analogy. We don't want to have the stability of the graveyard where everything's safe but nothing happens. We want a financial system taking risks, helping Canada adapt to our new environment. And if, as a regulator, if we're not open to that, then we're not doing our full job.
One of the things I think that was in front of everybody's radar was mortgage renewals and the risk that it could cause to the financial system. How have you worked with financial institutions to ensure they are adequately capitalized and that we go through this period without too much volatility?
Well, going back a few years ago, we had the COVID boom that was accompanied by a fairly aggressive run-up in mortgage credit, which is household leverage, a fairly significant run-up in home prices. And fortunately, we had much better data than we'd ever had, and we recognized that there was a cohort of households who were risk seeking, wanted the, bought houses that were came at a price and a level of debt that was very high relative to their income. And so, working in particular with the Bank of Canada, we just began to draw attention to it publicly and draw attention to it in our supervision. And that cohort has shrunk, as we measure it, by about half. And it is now systemically a very manageable risk. In other words, even if you make stress assumptions about that cohort, it's about 120 to 150,000 households, the system will be able to absorb that stress. Doesn't make it okay because those folks who are in that situation are going to have a difficult go of it, possibly when they renew. So and the the big period where you're going to see that stress is over the next 18 months, because if you think from 5 years ago today, a lot of people originated 5-year mortgages in 2020 and 2021. So from now through to 2026, some of those folks, or probably most of them, are going to have to renew. And they're going to have to renew in a different home price environment, different interest rate environment, and there will be some stress. And we don't relish it, but the financial system can absorb the costs of that stress, continue to lend, and in that sense, there is some good news there.
You spoke about the regulatory framework. I think that's a larger theme in economic policy right now. A lot of people feel that we've gotten a bit in our way in terms of regulatory, overdoing it a bit. OSFI specifically, I think you've taken some steps to streamline your regulatory framework, but maybe speaks to how you achieve that balance you spoke about.
Yeah. I mean, what we're trying to do is be responsive to calls from our regulated constituents, as well as other interested advocates, on what we can do to help the economy adapt in a fairly transformational period of time. And so the first part of this process is for us to communicate a willingness and to make speeches like this and say we are already lowering some regulatory static from the system, and we're open to considering what else we could do to help out. And our job is just to make sure whatever we do isn't too aggressive and doesn't leave a financial system in 5 years with a lot of risk concentration. But there is room for us to be smart about lessening regulatory intensity. We need help, and my phone's on, and my regulated constituents are more than welcome to come to us with ideas. I get the sense that we're doing a lot of the talking, and we're not getting a lot of response yet. So that I'd make, again, a request to my regulated constituents to keep coming to us with ideas. Candidly, we may say not yet or not quite to some of the ideas, but we won't say no to every idea. We are open for consultation and doing smart things to help the financial system, help Canada adapt.
Part of the mandate that has been expanded for OSFI is on integrity, security, and foreign interference. I wonder if you can speak to foreign interference
Yeah.
a bit to this audience.
Yeah. So in 2023, government did change our mandate. It specifically told us to worry about the integrity and security of financial institutions as well as those threats emerging from the world of foreign interference. And integrity and security, in my mind, is another word for non-financial risk, and foreign interference is a non-financial risk. Overall, it's actually a fairly limited threat to our system. I'm kind of glad we have some focus on it, but in our evaluation of the risk over the last 2 years, we've concluded it's a manageable risk that we can have visibility into, and we can take relatively discrete but meaningful actions when it flares up in a relatively quick period. And that's a fairly rare occurrence, and the occurrence itself is not terribly threatening to the broader financial system. It's a good thing that we have that awareness as regulators, because foreign interference can threaten the public trust Canadians put in institutions. So I do think we have to sustain our awareness, but what we've learned over the last 2 to 2.5 years, it is a contained and manageable risk that does not keep us up at night.
Thank you for this. Now moving to digital finance, digital assets. The world is evolving very fast. How do you think about it, and how do you deal with that?
So, broadly speaking, distributed ledgers offer a powerful opportunity to make financial systems more efficient. A lot of the innovation in that space is occurring outside the regulated system. I would rather have those innovators choose to join the regulated system and innovate within. There's a burden on OSFI to make it easier to do that, and I think I've said publicly we're committed to making it easier to bring your innovative ideas into a regulated system and innovate successfully within it. We have some proof points before us to make that real, and you'll be hearing more from us over the course of the next year or so. Financial system history teaches a number of things, but one very important lesson is innovation when it occurs just outside the financial system and attempts to win over business from the regulated system to an unregulated system, that tends to produce risk concentrations that tend to metastasize at particularly difficult times and creates costs for an economy. Now, the way we look at it at OSFI is part of the defense against that threat is OSFI being more open-minded to innovators, helping them get into our system earlier, and making sure they can innovate without restraint within our system. And that's what we have to get better at over the next few years. But I just want to leave the audience with, we accept our burden of responsibility in that regard.
I'll soon move to the questions from the audience, but you spoke about cybersecurity, and it struck me as something fundamental, again, on the risk side. Can you speak to it a bit?
Yeah, I mean, and I'll return to this metaphor of a theater of conflict. Like, cyberspace and financial system is a theater of conflict. And you have, in my view, the institutions re-regulate are by and large innocent bystanders in this theater of conflict. They need to build up their defenses. And the threat actors within that space are very innovative and very good at what they do. And they can harm the public trust in a financial institution if they succeed in their attacks. And so we've been encouraging our regulated constituents through our cyber risk management guideline and our third-party risk management guideline to think about investing in their defenses. Hard thing to do if you're a financial institution looking to maximize shareholder value, which is part and parcel to a healthy economic and market capitalist system. But imagine what happens to your value if your institution's trust is demolished by a cyber attack against your institution that you didn't invite, but that got through. And by the way, we see ourselves as similarly at risk, and we have a burden to bring up our defenses in just the same way.
Moving to the audience questions, I'll start with a question focused on SMEs. What is OSFI's view on reducing risk weights for small to medium-sized enterprises as you move into 2026? And do you want to see growth in this space from financial institutions?
You'll hear a bit more from us, I think in November, when we release our next iteration of capital adequacy requirements for banks. Our capital system is built basically on data for the last 30 years. And over that period, household lending, in particular residential mortgage lending, has had a heck of a run. And so if you look at our systemically important banks, which allocate capital based on their internal models, and these are public disclosures from their regulatory reports they disclose quarterly. Their risk weights for housing mortgages are about 10%, 12% in that range. And this would be uninsured residential mortgages. By contrast, their risk weights for corporate or small, medium-sized business loans can run in the 50 to 60% category. Well, that means for every $1 of capital you need to back a housing loan, you need $5 or $6 for a small, medium-sized business loan. Now, there's an array of historic data that you could use to justify that particular capital allocation, but it does cause one to wonder, to what extent is the way we allocate bank capital driving economic decisions, and are those decisions helpful to long-term prosperity and productivity for Canada, or can we do better? One vector, and we're open, here's why I mentioned my phone is, people know my number, they can call us with ideas, and we'd like to have more. We've proposed ideas. We need more input from the industry. There are some things we could do where we could perhaps use certain adjustments to our capital rules to make it a little bit more attractive to do small, medium-sized loans. In all honesty, we're not the silver bullet. We can just be, an additional accelerant to where we want the economy to go. But we're not, I just want to stress, we're not the silver bullet, that we don't solve this problem. We can just be a help to it. On the flip side, we just have to be mindful that when you're adjusting risk weights from a 30-year historic track record, you got to do that fairly carefully and fairly incrementally. So we're not going to be open to swing for the fences shifts in relative risk weightings, but in the margins where we can be smart, we'll do that. And we do see instances of other jurisdictions doing just that. So for example, in Europe, they apply a scalar or a discount to risk weightings for small and medium-sized business loans. If they can do it, we could probably consider it. So we're very much interested in being helpful and supportive in that regard.
Another question from the audience. 2 extra risks related to tariffs and housing market strains were identified in the latest OSFI risk outlook. How does this align with OSFI's latest pullback on FI examinations and guidelines?
Latest pullback?
Yes, latest pullback. That's the characterization here.
Oh, you mean a reduction of guidelines in our view
Right.
on the mortgage market? The guidelines that we have decommissioned and that we will decommission are not going to get to the core of examining credit risk, including residential mortgage credit risk. So I don't see what we're doing as affecting that. I think overall, the way we've supervised risks in residential mortgage, in the residential mortgage market, we've based that around something we call Guideline B20, which is residential mortgage underwriting policies. And we basically supervise at, if I'm being honest, a fairly granular level, residential mortgage underwriting. If I look, okay, what is the effect of that? Did it really affect residential credit growth? No. Residential credit growth has far exceeded economic growth in Canada over the last, well, most years of this century. And how are we doing on credit risk? Well, particularly since we implemented B20, delinquencies have been lower than they were before. So it seems to have been the right balance. While we can make certain, what I would characterize as incremental adjustments, for example, we've brought in a loan-to-income portfolio test for financial institutions for residential mortgages, which should cap concentration risk. We haven't really, and we don't intend to do anything dramatic in the world of residential mortgage underwriting supervision.
Thanks for this. Another question. Considering the banking sector now has capacity to absorb higher risk renewals, will consideration be given to reduce reserves or ask for reallocation to newer concerns like cybersecurity?
You're sort of, that question you're talking about, capital reserves for specific financial risks. I mean, we'll adjust that in the way we've talked about. Cybersecurity, third-party risk management, governance, those aren't really risks where buffer capital is required. I prefer to think of those risks and the guidelines we've attached to them as building operational safety buffers that aren't financial in nature. They may require a greater investment in cybersecurity personnel, a greater investment in cybersecurity digital protections, but they don't require more capital. In other words, an institution that suffers a massive cyber attack could still get into trouble even if they had outstanding capital. Financial capital is not the thing that protects against cyber risk or third-party risk. What protects against that is good operational discipline and investment.
Maybe this is the last question I have in front of me, so maybe we can conclude with that. In concluding thoughts, a question regarding the MQR, mortgage qualification renewal, the stress tests. A person says, right move in 2018, but today the new home industry is in a deep recession. Can we expect review, relief, change of MQR for new housing this year?
Yeah. So what we've announced, there's a series of answers to that question. We are doing a consultation starting in the new year on our credit risk management broadly, and that'll include a look at B20, which includes a look at everything in B20. One of the features, of course, is the minimum qualifying rate for uninsured mortgages. That's the part that we are responsible for. We've brought in this loan-to-income test, which is just a backstop test for excessive risk concentration amongst borrowers in a bank's portfolio. So we're limiting that risk concentration, and we think that'll be good systemically for resiliency in the mortgage, for mortgage banks, or for banks that make mortgages. Then there's the question of getting, well, what happens with the minimum qualifying rate? And that's why we have consultations. And the minimum qualifying rate, we could retain. And there's a lot of evidence, and the Bank of Canada has done outstanding research on this, that demonstrates empirically that the existence of the minimum qualifying rate produces lower credit loss. And that's not a bad thing. Do you want your bank regulator implementing that or not? That's part of what we'll consult on. If we I'll just maybe close by talking on that question about the Bank of England. The Bank of England had a loan-to-income portfolio test and a mortgage stress test. And they started it both in 2014 and in around 2022, after an in-depth analysis, the Bank of England concluded that the binding constraint was really this loan-to-income test, and they dropped their mortgage stress test. Now, I'm not saying what's right in England is right for Canada, and in fact, we have a very different loan-to-income test than the Bank of England. But you know, it's something we'll, as I've said, I think before, the loan-to-income test could be a complement or a replacement for the MQR, and we will consult with industry and get their feedback before we come to any conclusions, and that should start sometime in 2026.
It looks like we have time for one more. One more question came in. The IMF recently completed its review of Canada's financial system. I'd appreciate your view of this report, including the role of OSFI and FinTrack.
Yeah, it's a great question, and I'm glad we touched on it. So one thing we've learned is one of the threats, and I mentioned it in my speech, is criminal organizations attack honest financial institutions via their money laundering activities. And that is a threat to the integrity of an institution. We have to do a better job, and so do the financial institutions we supervise, in contending with that threat. And we've started that process. The integrity and security mandate changes helped. Another step forward, and it's in Bill C2, is taking FinTrack and OSFI, and taking FinTrack and putting it on OSFI's Financial Institutions Supervisory Committee. And why is that important? It enables better legal information transfer between OSFI and FinTrack. We have improved significantly over the last 2 years on that metric, but bringing FinTrack into the OSFI FISC, Financial Institution Supervisory Committee, safe harbor would allow us to be even more effective in collaborating together. And what we found is when we can legally get a view into anti-money laundering data from our partners at FinTrack, we can act as responsible supervisors in a way that lessens the threat to an institution. And I will be honest in saying I've been surprised at the richness, and I know banks in particular have legitimate concerns about the administrative burden of suspicious transaction reporting, but I can tell you there's a richness in that information that if we can detect clearly enough, we can act as supervisors in a way that does allow us to contend with that threat more effectively. And there's more progress to be made with better information transfer between OSFI and FinTrack.
On that, Peter, it's been a great pleasure. Thank you.
Thank you, Robert. Thanks, everyone.
A big thank you to Peter and Robert. So I hope that today's dialogue provided a clearer and a more comprehensive understanding of how OSFI is addressing current challenges, strategically preparing for uncertainties that lie ahead. Now, please mark your calendar for some of our next ECC events. On October the 30th, we're hosting our very first Maple 8 Pension CEO Breakfast. We will have the CEOs from OMERS, HOOP, BCI, and PSB sit down for a moderated conversation with Vashi Capellos. This is an event you will not want to miss. November the 3rd, we're hosting a luncheon supported by ICANN and CIRA, which will explore the next phase of internet growth. November the 10th, we've got our second in our series of women's health events. This one will be focusing on the menopause journey. Melissa Grello will be she will be leading the impactful conversation as our moderator. November 21st, we're hosting a luncheon, Isotopes for Hope, which will be exploring Canada's 2030 promise. And finally, don't miss our annual Economic Outlook Breakfast on January the 7th. Tickets have just started to go on sale. If you haven't attended this breakfast in the past, it's one you really don't want to miss. The chief economists from the big 6 banks will sit down with Vashi Capellos and give their forecasts and predictions for what is coming in the year of 2026. Registration is open for all of our events. Thank you for joining us this morning. Happy Thanksgiving, everybody. We'll see you next time.